Cathie Wood just sent an open letter to the chairman of the Federal Reserve, Jerome Powell. As we all know, inflation is raging in most of the world. The Federal Reserve is aggressively raising interest rates to fight this runaway inflation. Wood says that the Federal Reserve actually causing deflation by raising interest rates while it says that it wants to fight inflation. For those of you who do not know, Cathie Wood is the CEO of ARK Funds. ARK exchange-traded funds has invested heavily in high-flying tech stocks. Wood made herself famous by betting the farm on Tesla stock at a time when it was just starting to take off. But, she also had a portfolio full of unprofitable tech companies when Wall Street sentiment turned about a year ago. ARK Funds CEO Cathie Wood thinks that the Federal Reserve has actually crossed over the line by raising interest rates as far as it has. Wood thinks that the Federal Reserve is focusing on lagging indicators while the situation on the ground is changing quickly. So, what is really going on? What does this mean for inflation? What does this mean for interest rates? What does it mean for the US economy? And, what does it mean for the future of the United States? But, before we get into all of that, please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Wood says that the Federal Reserve is making a colossal mistake. Its hardline stance against inflation is actually causing deflation. Wood, CEO of ARK Investment Management, wrote all of this in an open letter to the U.S. Central Bank. She thinks that the Fed has the wrong focus by focusing on employment and price indexes from months ago. Wood said the Fed should be focusing more on commodity prices. Wood says that commodity prices show that the biggest economic risk going forward is deflation and not inflation. The Fed seems focused on two variables that, in our view, are lagging indicators: downstream inflation and employment, both of which have been sending conflicting signals and should be calling into question the Fed's unanimous call for higher interest rates, Wood said in the letter posted on the ARK's website. Specifically, the Consumer Price and Personal Consumption Expenditures price indexes both showed inflation running high, Wood said in the letter. The headline Consumer Price Index rose 0.1% in August. That index was up 8.3% from August of last year. The headline Personal Consumption Expenditures Price Index, PCE, accelerated 0.3% from the previous month and 6.2% over August of last year. Both index readings would have been higher excluding food and energy. But, food and energy experienced substantial price decreases over the summer. On employment, payroll growth has decelerated but remains strong, with job gains totaling 263,000 in September as the unemployment rate fell to 3.5%. But Wood, whose firm manages some $14.4 billion in client money across a family of active ETFs. Falling prices for items such as lumber, copper and housing are telling a different story, said Wood. The Federal Reserve approved 3 consecutive interest rate increases of 0.75 percentage points so far in 2022. And, this was mostly done by unanimous vote. Wall Street analysts expect to approve a fourth 75 basis point increase when it meets again on November 1st to 2nd. Unanimous? Really? Wood wrote. This 13-fold increase in interest rates during the last 6 months is unprecedented, Wood continued. The Fed has shocked not just the US but the world and raised the risks of a deflationary bust, Wood added. Too much inflation is bad for the economy. It raises the cost of living and softens consumer spending. Deflation is also a risk that involves falling demand. It is mostly associated with pronounced economic downturns. But, the Fed is not alone in raising rates. 40 central banks worldwide have approved interest rate increases during September. And all the Fed's moves are basically baked into Wall Street expectations. Cathie Wood is not the only person who thinks the Fed could be going too far and risking dragging the economy into an unnecessary recession. Without question, food and energy prices are important, Wood wrote. But we do not believe that the Fed should be fighting and exacerbating the global pain associated with a supply shock to agriculture and energy commodities caused by Russia's invasion of Ukraine, Wood continued. The Fed is also expected to follow the November rate hike with a 0.5 percentage point rise at its December meeting. And, also, then a 0.25 percentage point increase early in 2023. One area of the market known as overnight indexed swaps is pricing in 2 rate cuts by the end of 2023, Morgan Stanley said in a note to investors. Wood says that Powell is on a path of outsized interest rate hikes to tame inflation, and it is a disaster in the making. Inflation is quickly turning into deflation, Wood said. That means the Fed will likely have to pivot away from its interest rate hikes sooner than the market thinks, Wood continued. Making matters worse is the fact that the Fed is overly focused on lagging indicators like employment and core inflation, continued Wood. The Fed should be focusing on real-time developments in the economy that show signs of deflation, Wood added. Leading inflation indicators like gold and copper are flagging the risk of deflation, said Wood. Even the oil price has dropped more than 35% from its peak, erasing most of the gain this year, she said in a tweet on Wednesday. Many commodity prices have plunged and are trading at or near pre-pandemic levels. Gasoline prices, in particular, have dropped quickly since the June peak of $5 per gallon reached in June. The current U.S. average is $3.75 per gallon, according to AAA. In the pipeline, inflation is turning into deflation, Wood said. One of the best inflation gauges, the gold price peaked more than 2 years ago in August 2020 at $2,075 and has dropped 15%, added Wood. Lumber prices are down more than 60%. Copper is down 30%. Iron ore is down 60%. DRAM prices are down 46%. And WTI crude oil is down 35%. Retail company inventories have swollen in the past few months, compounding the reversal of inflation into deflation. This could lead to hefty discounts for consumers during Christmas shopping season. If inflation is about to turn into deflation, as Wood suggests, then the Fed could find itself in a scenario where it over-tightened monetary policy and needs to pivot to prevent the economy from entering a hard downturn, continued Wood. Rising interest rates have cut the value of ARK Invest's flagship investment fund by a lot. The ARK Disruptive Innovation ETF fell 74% from its peak in February 2021. Federal Reserve Chair Jerome Powell has now recommitted to battling inflation. Some Wall Street analysts say that inflation is abating. The inflation pressures have come largely from pandemic-specific causes, said Powell. The Federal Reserve waited until March 2022 to start raising interest rates. But the U.S. labor market is still strong, and that also contributes to higher inflation. Powell wants to make sure that higher labor costs are also under control because it is a factor in inflation. The economy could experience some pain from tighter policy, Powell said in a speech in Wyoming last month. What we hope to cause the labor market to get back to levels that are more consistent with 2% inflation over time, he said. Wall Street analysts are betting that the Federal Reserve will stay the course of its aggressive path of interest rate increases to defeat inflation. This comes even as the unemployment rate is ticking up and layoffs are sweeping the U.S. economy. That means that layoffs will continue and unemployment will keep rising. But, what do you think? Please leave us a comment below. We would love to hear from you. Please hit the like button. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.